There's potentially going to be a big move in interest rates coming over the next few months. First off, supply and demand. Let's go straight to the Twitter. For a little while, the TGA has ran up its account, as we can see over here. But right now, the TGA is running down its account, which means every single month they are not issuing too many bonds because they already have the money in their account to service their debt. The importance of this is the 10-year is already over like 3.3% and increasing at pretty drastic rates. So what happens when there's situation in a few months where instead of the TGA running down its account, it has to build its account back up and it has to start issuing more bonds? That's going to have an increase of supply on a market that already seems to be losing interest in demand for bonds. Another reason is everyone knows QT has already started. And if we look at the Fed's balance sheet, it's already plateaued and is starting to decline. The importance of this is, as everyone knows, that they're selling bonds, that's going to add even more supply on a actual market that is losing interest and having less and less demand. The reason for that, there's many reasons, but I'd say the main one is inflation keeps on printing higher. And if you're in the US, there's absolutely no reason to hold bonds because you are guaranteed to lose money.
Yes. The thing I find interesting, and I don't know how this is going to play out, but I mean, think back to, Snyder and Emil, what they always talk about, where you basically have a dollar, or you have a collateral shortage. And if the TGA is high and the Treasury is not going to issue as many Treasuries, and if Treasuries are the coin of the realm, or at least the tier one collateral, or part of the main source of tier one collateral that are used in the federal star system, the lack and the drawdown going on Treasuries, forget what happens on interest rates, but just think about in terms of the I want to use the word plumbing, but it's probably a more accurate way to describe it. My point, though, is this: if the system wants Treasuries to provide collateral to itself, and if the government is not issuing, or is issuing less Treasuries than it did before because it doesn't need to issue as many, as you noted, Josh, with the TGA being high, I wonder if there'll be any knockoff effects that'll come down the pike from that. And that's completely independent of whatever happens with the interest rate situation, too. So,
yeah, I mentioned that in the Twitter thread as well, that right now there's artificial and extreme amounts of demand for treasuries. First off, as it is the prime collateral in every single repo agreement across the entire global monetary system. It is almost 1/2 of every transaction, where there's trillions upon trillions of transactions a day. The second is foreign demand. There's like, if you're a foreign currency and foreign government, bank, anything, you have artificial demand for bonds, for US bonds specifically, to hold a counterparty risk as opposed to for your currency. If you think your currency is going to go down and you think the dollar might appreciate, you have that demand for dollars. You don't care what US inflation is. You only care what the dollar is going to do against other currencies. But we are still seeing, with all these factors, we're still starting to see bonds increase in interest rates, increase in value. 10 years up over 3.3%. As of last time I checked. So just from what we can see right now, where there's relatively low issuance, there's going to be a situation in a few weeks and few months where the Fed's not going to have the markets back anymore, and the TGA is going to be issuing more bonds, meaning there's going to be a lot new supply that the market's going to have to absorb, and that's most likely going to take interest rates up with it. What is the real importance here, though? What happens when interest rates rise? It's going to put massive amounts of pressure on corporate profits, on mortgage rates, on pretty much absolutely everything that you can see. All these businesses that are running upon historically low debt that needs to start refinancing for their business model to maintain their revenues, because most of them don't actually make profits, are probably going to go under. A lot of these real estate guys who are leveraged to the tits on historically low interest that can just refi till they die won't be able to do that. That's going to cause a lot of downward pressure. There's just a lot of recessionary risks that are happening, especially if we see a situation where in a few weeks and months, when the TGA starts running up in its account and the Fed's really selling bonds into the market, if the 10-year goes to if it's not 3.3%, but if it's 4.3, if it's 5.3, corporate profits will almost just get completely decimated. And there's just severe risks going into the next few months, looking at the economy.
And that's, of course, assuming that the interest, or that the revenues are denominated in the same currency your expenses are denominated. If they're not, then you've got to your problems have just compounded upon itself.
Yeah, it does not look good for the stock market going out a few months. I think that we could see a pretty nice relief rally, but that is not, I don't think it will be long-lived. Everyone says that everyone's bearish on the market, but it's not always wrong to be bearish when every single indicator looks like it is going to be going down. There's no stimulus being passed. In fact, liquidity looks like we're seeing the bubblings of drying up. We can see that in Argentinian corporate paper just going bananas. We see Japan going crazy, the US dollar continuing to rise. There's just a lot of bad signs and nothing good. Let's think back to March of 2020, and for the past or for 2 years straight when the stock market was going up, everyone was bullish. But were you wrong? No, you were right, because there was a lot of new dollars circulating in the economy. Let's just take a simple example. What if the government gave $1,000 to everyone one day? I'm sure the price of a lot of goods would increase drastically overnight because everyone wants to go buy something. But what would happen? What happens if they just stop giving people $1,000? I would assume that would dry up over time. It's just the way the world works. And right now, the government is not giving people new dollars. There's not new dollars being created every single day that you need to sustain these inflationary pressures, especially in asset prices. So just because a lot of people seem bearish on the market does not mean that everybody is wrong. In fact, most people are still buying in their pensions and 401ks, and especially in these crypto markets. So there's a lot of negatives going out over the next few months in the real economy. I mean, who cares about asset prices when a lot of people are going to be crushed in the actual real economy? People aren't even be able to compartmentalize these anymore.
Yeah. Josh, like I said, I being in real estate myself, the only other thing insight I can add, which I've shared before, is we're eventually in sell mode, not necessarily in buy mode. We also know that eventually, the things flip around and buyer once the weak holders get. But one last thing to note too is that I'm very interested to see what happened this past week with crypto. Not to get too far down into that, but I wonder if we were looking at a liquidity event crypto. And I don't have Out of the Woods yet, but to the best of my knowledge, Tether still manages to meet redemptions. So there's that.
Yeah, right now there is no liquidity issues, but what we were just talking about with the interest rates, if these interest rates start to spike in an uncontrollable manner, that is going to take everything with it. Thank you guys, and we'll see you in the next one.